About a month ago, Carl Lantz told us U.S. interest rates would keep falling. Today, 10-year Treasuries are yielding less than 3%, and 2 years are trading at their lowest levels in more than 6 months. Carl is the head of U.S. interest rate strategy at Credit Suisse. He's back to tell us what's going to happen next. Carl, do these rates have further to fall? Is that really possible?
I think it is possible. I don't think they're going to fall significantly more. But, 2-year yields and in are going to be very well anchored at these low levels, and I wouldn't expect them to move much anytime soon. I think on balance, we've seen more evidence that the Fed's going to be on hold for an extended period, which they've been saying, but the market doesn't always quite believe it. Further out the curve, I think in 2 months' time, we'll probably see 10-year yields a bit higher, but not dramatically so, maybe 335. And before that, we'll probably test levels below 290.
I'm giving you big props for calling the decline in yields, but the truth is you were looking for more action on the very short end of the curve.
That's right.
We haven't seen as much. We haven't seen rates on the 3-month bills or the 6-month bills drop perhaps as much as we've seen them fall on the 10-year. Why is that?
Well, I think that has more time to play out. So at the very front end, it's all about supply and demand, and supply continues to fall as the Treasuries reach the debt ceiling. And
no new debt to be issued until they resolve that problem.
To be issued. So I think over the next couple months, until that August 2nd date at least, you're likely to see supply continue to fall, and you will get those yields modestly lower.
Now, you made the point when you were here last that that is a money-making opportunity, but only really for institutional investors that can put leverage to work, because otherwise the decline is just too small, even if it goes to zero, right?
Right. For most of us, it means our money market mutual funds will drop their yields from, 7 basis points to 6 basis points. So I think, broadly speaking, it gives more incentive to investors at large to move out into, say, corporate bond funds or even equity funds. And I think, the market has perhaps given you an opportunity to get into those riskier assets.
Carl, you're an interest rate strategist. Yes. The guys in your desk are screaming bloody murder right now. You're telling your clients to go into equities and credit. You believe that there's more value there?
There is more value there, but I think you always have to keep in mind that the Treasury market, it needs to be a core holding, because when you see a risk-off move, like you've seen too much of, unfortunately, of late, you do see Treasuries always respond in a positive direction. So on these days when you get Greek headlines, everything is down. The only green prices are on your screens are Treasuries. So they're important for diversification.
There has been a lively debate, I don't need to tell you, between the folks at PIMCO and the folks at BlackRock about whether or not U.S. Treasury yields are safe at these levels. So far, anyway, Bill Gross has proven to be wrong. You're in the BlackRock camp. You think Treasuries have been safe. It's not to align all you firms with each other. Everybody has his own view. Right. But you just said yields may back up a little bit. Do you feel that they only have a limited amount of room to back up, and that maybe in and around the 310, 315, 320% neighborhood, they're okay?
Yeah, that's right. I think you'll see a modest, slow backup that doesn't really pay you for being underweight, because obviously you're foregoing carry on the securities by doing so. With all due respect to PIMCO, we disagree a bit on the view, but PIMCO has a lot of tools at its disposal that a lot of investors don't. So they use derivatives, they use currencies, they do a lot of things that have so far helped them to actually beat the benchmark. So, I'll give them all due respect on that. But, for most investors, I think I don't think it's obvious that you should be out of Treasuries altogether.
Right, and Bill Gross has demonstrated that, yes, he's been able to invest in other things and make the kinds of, not just the kinds of earn the kinds of appreciation that other people have seen in Treasuries. But a point that Larry Fink of BlackRock made to me last week is that one of the reasons he believes Treasury yields have been declining is because all kinds of commercial and industrial loans on bank balance sheets are maturing, and there aren't new loans to make. So the banks have been piling into Treasuries because they need to hold some assets. Do you agree with his view, and do you think that's a trend we might see continue?
No, that is right. You can see that in the Fed's own data, that banks have been moving into both agency mortgages and into Treasuries. They continue to see a lack of loan demand. And commercial banks are now, commercial and foreign central banks are now buying Treasuries again at a pretty good clip. And against that tide, you have a lot of hedge funds betting against that, betting rates need to be higher, and continually being stopped out of that trade.
Well, at some point in the future, they will have to be higher. Who knows when it's going to be?
Right.
You will at some point, and you'll be back to tell us, I'm
right,
sure.
Erik.
Carl, thanks very much for being here with us. Carl Lantz, Chief Interest Rate Strategist for the U.S. at Credit Suisse.